Welcome back. This is Corporate Radar, and as promised, let's shift focus to GE Shipping. Now, the company has recently sold, a 2005-built Suezmax crude tanker, and also has planned 2 fleet acquisitions in Q2. We have with us Mr. G. Shivkumar, the Executive Director and the CFO at the shipping company. Hi, sir. Good morning. Thanks a lot for joining in. Well, we're coming to you in just a bit, but for now, just highlighting the 3 big talking points that we're going to be looking at. There's been multiple sale purchases of contracts for vessels. Point number 2 is the current business landscape and the spot rates. And point number 3, changes due to the geopolitical developments and how things are panning out on that front. So lots to discuss. Let's get straight to the action then. Mr. Shivkumar, always a pleasure, sir, having you on the show. Lots to talk about, so let's get straight to the point. 3 ships have been purchased, 1 ship has been sold. How are the asset prices for the new as well as the older ships? And are there any plans on conducting more such activities, that is, buying or selling some of these ships? Do you have some kind of outlook in the near future?
Morning, Nigel. Thanks for having me. Yes, we've currently contracted for purchase of 3 second-hand vessels, 2 bulk carriers and 1 Suezmax crude tanker. And we have contracted for sale of our oldest crude tanker as well. These transactions, and this is what we've been doing over the past 2 years, prices have been significantly higher than our comfort levels. And therefore, we've been focusing only on maintaining capacity, not doing capacity expansion. So we've been selling older, less efficient, less desirable vessels and moving them to similar types of vessels which are younger or more marketable. So that's what we've been doing. For instance, you'll see we sold a 2005-built Suezmax and we bought a 2010-built Suezmax. So what we're doing is we're extending the runway till we can get the market prices that make us comfortable to do a significant expansion.
Okay. All right. So, Mr. Shivkumar, just to get this clear, obviously the older vessels, they'll be, calling for higher OPEX, higher amount of spends as well, and profitability could be relatively less. That's why you're looking at getting in the new set of vessels. Is that correct?
OPEX, not so much. There is sometimes maintenance CapEx, which is higher. However, what happens is on the revenue side, because they are less freely tradable beyond a certain age, and therefore we'd like to have our ships freely tradable to maximize revenues. It's more on the revenue side than on the cost side, really, so that we can maximize revenues by having the maximum optionality for trading those ships in the international spot market.
Okay. All right. Give us some more color then. How are the new vessel additions, sales expected to affect the company? Say the revenues, the margins, the NAV as well. If you could give us some kind of insight.
No change really in the NAV because we're buying them at market. And we're capturing part of the NAV gain by selling the older vessel. So we'll book a profit on sale on the old ship that we sold. In terms of revenues, yes, the capacity goes up. But finally, for us, it's the rates which have the bigger impact on revenues. The capacity, of course, is a factor, but the significant swing factor here are the rates. These capacity changes, we're talking about 3 ships, of which 2 are incremental. It's not huge. It's on a 40-ship fleet. It's 5%. The rates move by 10-20% in a week. So that's really the big factor that moves revenues.
Yeah. Mr. Shivkumar, what's the net? Good morning, Prashant here. What's the net outflow because of these transactions?
This would be a net outflow probably in the region of $60 to $70 million, something like that. $60 to $75 million.
$60 to $70 million is the net outflow after these, because these transactions. And you fund this how, and what's the cash levels post this?
Yeah, so we have about $800 million in cash currently. So we'll just fund it out of cash for now. We'll be using cash to fund, a lot of our expansions before we go into taking debt, really. Because there's so much cash sitting there, we might as well use the cash before we really draw down any debt.
Okay, so you're using basically about 10% of it.
That's right, less than 10% of
less than 10% of your existing. And are you doing this for many more, or are you done with these vessel swaps in that
We've done,
sense?
I think, 8 or 9 of these transactions so far. We would be looking to do some more. We're always looking at these opportunities to do some modernization of the fleet. And if we get any transactions that make sense, we will do those. But again, mostly we'll be doing just the switches, which is you sell an older vessel and get into a newer or a better spec vessel.
Give us a sense of how business is
Yeah, so
across segments now, Mr. Shivkumar, now compared to, say, we left off at the end of the last quarter.
That's right. So the one significant thing which has happened in the markets, in the crude tanker market specifically, is that OPEC came back with more oil into the market starting from May, June. That's starting to have an impact on crude tanker markets now, which is basically you're having more oil that is being transported, which means you need more ships. So the rates for the large crude tankers have gone up a lot in the last 2 weeks. We don't have the VLCCs, which are the 2 million barrel ships. So those have gone up to, I think, $80,000 a day from maybe $30,000 to $40,000 a day 2 to 3 weeks ago. And those typically are the most sensitive to OPEC oil production and OPEC exports. It hasn't filtered through to the other sectors, a little bit to the Suezmaxes that we operate. So those also have gone up. Net, we are about at the same levels as last year, a little bit better, maybe a few $1,000s better than we were 2 to 3 months ago in terms of spot rates for Suezmax tankers. For Aframaxes, it's much of a muchness. For MR tankers, we are probably better off by 1 to 2,000. And again, MR tankers that's the sector where we have maximum exposure. We run 12 ships in that sector. Those rates are up by about $1,000 to $2,000 a day compared to where they were a couple of months ago. Coming to dry bulk, we've had a surprisingly strong market, mainly on account of, and Nigel mentioned geopolitics, possibly on account of some front loading of grain imports by China, soybean imports by China. We've had the smaller ships having a pretty strong market over the last 2 to 3 months. Basically, the US grain season starts in October, the soybean season. And I think they've been stocking up, the Chinese importers have been stocking up from Brazil and Argentina, preparing for a situation where tariffs may make that grain unaffordable.
Point taken, Mr. Shivkumar. That's a pretty comprehensive sort of picture that you draw out. So all told, I mean, at a company level, what does this mean? I mean, as we progress through the quarter, where does it leave us?
Currently, where the rates are sort of net around where they were a year ago.
Okay.
Maybe marginally better than the previous quarter for some tanker sectors, but not very different. So prices are pretty high. Prices of ships are pretty high, and that's why we are not doing any significant expansion. So we are still waiting for those opportunities. So for now, it's a holding operation. We make significant cash flows at these rates, significant free cash flows at this rate. We are still really collecting the cash and waiting for the market to give us the opportunities and the prices to buy.
Always a pleasure, sir, having you on the show. Thanks a lot for joining in. Post your Q2 numbers. We'll re-invite you, and maybe we'll try to pull out some numbers as well from you. Wishing you a good day ahead.
Thank you.
Well, I think the street likes actually what Mr. Shivkumar had to say. I think the stock was more or less flattish. It's seen a bit of an up move here in the last few minutes or so. So keep an eye out on the bottom of your screen. Those are the important takeaways.